Okay, so today's cardinal lesson is a fun one, paying taxes. And it actually paying less taxes is the fun part about it. How much income how much income tax do retirees pay? And I've shot several other versions of this video that we've come at it a different way. And I always get some smart Alex that are writing in. It's the same as people under 65. Working people pay the same taxes, and they've got a little hit with it. And I'm just like, okay, I guess what I said in the video didn't really ring with you, but I'm just telling you, when you're 70 years old and you're collecting a Social Security check and you're pulling money out of your retirement account, putting the two together to live, you're going to pay a lot less in income taxes than you did before 65, especially if you're in these middle income, upper middle income kind of department. Now, if you have a very high income, that may not be true, but we're just dealing in the real world here. And today's lesson, we're going to finish and spend most of the time with Tom using the tax returns and the software that he uses. We do mock up tax returns on just about every financial plan we do. We even do this when we're just doing some income planning for people. Tom's going to do a mock-up tax return, and it always gets my attention. I'm sliding over there and watching everything he's doing. So we're going to be doing that live with these four examples today. And what we have up here again are the tax brackets for married, filing, joint, and single. We got the standard deduction for people over 65 is $32,300 is the standard deduction if you don't itemize, which is quite a bit of money, especially in these examples you're going to see. You don't pay taxes on all your Social Security, and you'll see the effect of that. And then we've got the capital gains tax here, and you'll notice that for married couples, the top of the 0% bracket of capital gains is 94,000. So it could be that if these people here had some land to sell or something, or some stock to sell, that they could actually pay a 0% 0% tax, federal tax on the capital gain. So I don't want to steal all of Tom's thunder. I want to bring Tom on and talk about why are we really doing this, and then get into the examples.
I mean, we're doing this video because in retirement, what's really important is how much money you get to keep. It's not gross income. It's not how much you're bringing in. But you also have to account for taxes. And so we just wanted to show you is once we fast forward, you're on Social Security. We've done some planning. Maybe we can keep your IRA distributions lower. There's a chance you could pay very little in taxes in the big scheme of things. And so we just want to show you some examples today of how that can work. We have the show notes and one thing we've done differently on this one than previous videos is we've actually printed out in the show notes the examples we're going to go over real time. So if I'm going too quickly, you can't really see it very easily. Print these out and you can follow along in the show notes what I'm going to build just real time with us. So we got the board, and then we have the taxes. And this is a chart I have on my desk. I use it all the time where I look at the tax brackets, look at the different rates, and plan there. And then these are just printouts. I'm not going to spend a lot of time now going over this because we're going to do it real time. But these, if you want to print these out and look at them more closely, and and see how that might to your situation, you can do so. I will point out today we're just going to be talking about federal taxes. We're going to ignore state taxes because each state's a little bit different. So there could be some additional tax there. And these are also the couple, and we've done a couple and a single person. All are 70 years old. Again, if you're below 65, the standard deduction will be a little bit less, and so just this isn't going to model your situation exactly, but it will give you a general idea. So let's get in here and start building some tax returns. Just real quick, I'll just show you. I just put a hypothetical. This is a married couple. They're both 70 going in here. And so what we want to do is the first one, and this I'm going to do it in the same order that we have on the board. The first couple is we have a couple who has started Social Security. The one spouse is getting $2,000 a month, which would be $24,000 annually from Social Security, and then the other spouse is getting $1,000 a month. So this might be a spouse who's just getting the spousal benefits, and so we're gonna say they're getting $12,000 a year. That's $1,000 a month, and they're having to supplement that and taking out $2,000 a month out of their IRA. So that's another $24,000 a year out of their IRA. So in terms of total income, monthly income. We have 2,000 from one Social Security, 1,000 from the other Social Security, so that's 3,000, and then another 2,000 from the IRA. That's a total of $5,000 a month of money coming in. When we go look how that relates to the tax return, is we can follow through. We have the IRA distribution here. We have the total amount of Social Security. You'll notice a little bit of it is taxable, and so they're only paying only 5,000 of that is taxable income. Not that they're paying taxes on it, but it's included in their taxable income. We go down here, they add those two numbers together to get to 29. This couple, their standard deduction in 2024 would be 32,300. That's more than what their income is. So they have, if we go down to line 24, which is their total tax, it's zero in taxes. So they get to keep all $5,000 of that income and not pay any federal taxes on doing so, which is really sweet. I mean, that's a, if you were earning $5,000 a month from your paycheck from working a W 2 income, you're not going to nearly get to keep all of that. So it's a really sweet deal that you have sort of in retirement. So that's sort of one example. Again, if you were looking at this and my numbers are different, you want to call us, I can do one of these just with your exact numbers. So just reach out here. Um, Now we're going to go to another example. And so these ones are maybe have earned, were higher earners while they were working. They have higher Social Security checks, maybe just need a higher standard of living. And so we're going to have the one spouse in this example, the wife earning $4,800 a month from Social Security. So they max it out. They waited till 70. They got the full amount they could. That annually, that's $57,600. And then her husband, and again in this scenario, is earning $3,000 a month. So he also had a pretty good working history, not quite as high as the wife, but that's $36,000 a year from Social Security. Then they're also needing to take more out of their IRA. So we're going to show taking 5,000 a month out of their IRA, which would be $60,000 a year. Put that in here. And now we're going to go to the 1040. This is where it all gets pulled in. So again, we'll have the 60,000 coming in from the IRA, $5,000 a month. We have the 4,800 and 3,000, so another $7,800 a month coming in for Social Security. Um, you'll notice that not all of that is taxable. And so, based off the formula that Social Security uses or the IRS uses to calculate how much tax you owe on your Social Security check, they're getting $93,600 of Social Security benefits, and they're only paying taxes on about 60,000 of that. So it's a smaller percentage. Now, if you make more than that, that caps out at 85% of the check. That's the most you'd ever have to pay. So everyone at least gets 15% of their Social Security tax free. But when we talk in other videos about Roth conversions, one of the real benefits of Roth conversions as it relates to Social Security is if we can do the Roth conversions prior to you starting Social Security, and now we get to take some money out of Roth IRAs as opposed to traditional IRAs, we can keep more of your check that you get to keep, less of it will be taxable. But we add these numbers together, we take the standard deduction of the 32,300. Their total taxable income is $87,000. On that, they're only paying 90, just under 10 grand a year in taxes. So they still get to keep a lot of that money. When we finish these examples, we'll get back to the board and we actually have sort of what the effective tax rate they're having to pay on. But they get to keep a lot of their money. So they have a really high income in the big scheme of things. And most of it they're getting to keep. Again, ignoring state taxes. Um, Now we're going to go look at because a lot of our viewers are single, they're not married, and so let's go look to see what a single tax return looks like. Again, we're going to make the person 70. Let me go update some of these numbers. We're going to use sort of similar numbers here, but we're going to have the one spouse, and we're going to do sort of the same thing where we have maybe a lower one and then a higher one. We're going to have 36,000 or 3,000 a month from Social Security. I think that's what we did on the board. Let me double check that. Um, yeah, okay, 3,000. I had to make sure what I remember what I did here. Sorry. So 36,000, which is 3,000 a month coming in from Social Security. And we're going to keep the same 2,000 a month in that first example of IRA distributions. So the income is actually the same as the couple on the first example, except now we're filing taxes as single rate. So you'll notice more of the Social Security check is taxable, just based off the formula they use. Their standard deduction is less, so you'll see that here. It was 32.3, I think, at the other one, so it's less there. And so in the first example with the couple, there was no taxes. As a single person, you're still paying some taxes, but it's still pretty low, only $2,000 annually in federal taxes. Now we're going to go to uh, sort of increase these numbers for the Social Security. So let's go back here. We're going to have the person, same situation. They maybe waited till 70. They're getting $4,800 a month. That's 57,600 annually. And then from the IRA, we're going to do 5,000 a month, so 60,000 a year. And then we're going to look at the 1040. Again, that all adds up. This single person, they are paying 85%. 85% of their Social Security is taxable, so it gets added to the 5,000 a month, the 60,000 a year of IRA distributions. They take the standard deduction. So the single person earning that higher income is paying 15,000 or so in taxes. And so you can really just sort of see the difference there in married filing jointly tax rates and single tax rates. Again, this is not a video to tell you to go get married. You need to make that decision other than the taxes. But this just illustrates sort of what the taxes are going to be there. And so let's go back to the board. We'll bring Hans back on here and we sort of talk a little bit more about sort of the effective tax rates here.
Okay. So when we made these examples, we started with the income that we felt was realistic, and we started with the Social Security checks that we felt were realistic of what we see coming in. But the thing that we did is we created the income first, and then we went back and saw how much tax we have to pay, and then we ended up with how much we've got to keep. And what we like to do in financial planning is the reverse of that. When we're setting up a retirement income, you're not going to be working anymore, and your sources of income are going to be Social Security, and they're going to also be withdrawals from a retirement account, which is pretty typical. And then people really don't know all those numbers are, so that's why they hire us. And so what we're going to do is we're going to sit down and how much do you want to spend? How much do you need to spend? How much do you want to spend? And we're really going to come up with a number, put some cushion in there. But we find a lot of retirees spend less than they thought they were going to spend. And a lot of people that have big retirement accounts, they just live off their Social Security checks and maybe a little bit something else. And so let's go back through these, because when we actually do this examples, we're going to turn these into real people. And I'm going to show you a few things we learned. Number one is the first couple, these people have got $5,000 a month to spend because they're paying zero taxes, most likely zero state taxes. And what I would propose to you is they're still leaving money on the table. I mean, I don't necessarily want to have zero taxes in retirement. By that I mean, if they're able to draw out 2,000 a month out of their IRA, and if we're going to recommend that to people, there's a pretty sizable IRA or 401k there that can sustain that amount. Like four or $500,000 in a taxable IRA, which is a lot typical with people at income and Social Security checks, especially if they both worked and we're putting two of them together. Um, so they may look at this and say, well, now that I saw my taxes are zero, I don't really need 5,000 a month to spend. That's $1,250 a week, and we got our house paid for. I don't know if we can spend all that. Well, first of all, what I'm going to do is I'm going to say, well, we're going to do at least a $24,000 Roth conversion. Okay. I mean, we're going to do at least that because you're going to pay zero taxes on that 24,000 that you're pulling out of your IRA. Nobody says you have to spend it. And if you're not going to spend it, let's convert it. And let's make it tax free in the future for us or for our children, or when one of us outlives the other one and the second spouse lives on, they're going to be single taxpayers. So let's do this conversion now so they can pull out of a tax-free account. Or if we're both gone and we're passing this on to the kids, we'd rather pass on Roth money. So what I'm probably going to do with these people is we're going to have a discussion about converting even more, because I got a feeling that they could go up higher and still be at the zero tax rate. And we're just going to convert all that. Second couple. This couple, I mean, we end up with, these are a couple of professionals. One of them uh, did a little Mr. Mom if it was the dude, he probably, they're both professionals. She made the highest possible Social Security check that you can get at this time, which is 4,800 or thereabouts. He's not that far away from that. So that's 7,800 bucks a month. It's almost 100 grand a year, short of that, but it's 93,600. And then you add 60 grand of IRA withdrawals. Well, they got to have some really sizable accounts to be able to sustain this, or we certainly wouldn't be recommending it. But they probably do. They probably both have accounts. And if they haven't gotten into Roth conversions yet, I mean, we need to start drawing that money down and spending it and enjoying it. But what really sticks out is they have a total income of 153,600. And when you were working, if you between the two of you made 153,600, you'd probably assume that you're not going to have but $100,000 a year to spend. I mean, they're going to take about a third of it is going to go to taxes, Social Security payments, Medicare payments, 401k contributions. I mean, you pretty much are going to be at best get 2/3 of your check. The same is not true in retirement. This couple, their federal tax is just short of 10 grand, which is 7% of their net income. And that's just because Social Security isn't taxed totally. And the income tax is mainly calculated by the 60 grand. And then they've got a $32,300 standard deduction. You plug all that in, they're paying 7% tax, and they're going to be left with, well, they're going to have some state tax if they live in a taxable state. But a lot of states that have a state income tax, they don't tax Social Security. So, that this is going to be nominal. So this couple's going to have, 140 grand a year. And again, they may not need that much. If everything's paid for, they're retired. And so we're going to do a Roth conversion with this IRA withdrawal. We're also going to sit down and look at this. They may want to do a whole bunch more Roth conversions before they get to minimum distributions. And that's kind of off the sheet here.
On that couple, I want to make another point too. Is oftentimes we get people coming in and they're telling us how much tax they want us to account for, and it's like, well, hold on, let us calculate that. You tell us how much you need after tax, and oftentimes they're surprised. If I told them on their way in, you're going to get $153,000 of income, most people are going to go look at the tax brackets that's in the 22% tax rate. They say, okay, I'll pay 22% tax on my money. That's just not reality, right? 7% is clearly much less than 22%. So most times people are overestimating how much tax they're going to have to pay. And in reality, they get to pay less. Now, that's not every situation. It's specific. We need to do some planning to get there, but you really are going to pay potentially a lot less in taxes than you think in retirement.
Yeah, bingo. And, as I said in the beginning on this couple, we don't start with this is how much money you're going to have, how much tax, this is how much you're going to get. What we're going to do with most people is we're going to start, how much do you need? And then we're going to show them how they can get that much and how much tax then they're going to have to pay because we're in control of these IRA withdrawals. And so we're going to come at the number of tax and the amount of tax that matches their need. And then when they see how low the taxes are, they may decide to get into the Roth conversion business or do something to prepare so they're not paying a lot of taxes in the future when they get to minimum distributions. Some of these people have multi-million-dollar IRAs, and once minimum distributions start, you're no longer in control of this number. You've got to just take what the government sends you. Number three, not what the government sends you, but what the government requires you to withdraw from your IRA. Okay, this single 70-year-old person, Tom already showed you the example. We've gone from same income, little difference of Social Security, but a single person, we've gone from zero tax to 2021, a little over $2,000 in tax, and probably some nominal federal tax. It's a 3% rate. that right? Yeah, 3%. Number four, this is the single person, 70 years old, has a large Social Security check. This is a retired professional, or it could be a widow or widower of a retired professional getting that maximum check at 70, and then they're drawing out 60 grand out of the IRA. They've still gone to $15,000 of federal tax, and it's still just 13%. So we would do some more work with all four of these people. We wouldn't just calculate the tax, say this is what you get, this is what you're going to pay, because what we're going to want to do is year by year by year make this number and this percentage what we want it to be and what you want it to be. And what we're going to do is when we take more than we need out of the IRA, we're going to do a conversion so we have the availability of tax-free money down the road. So um, I want to get on and just talking financial planning. We could go on all day about this, but we just wanted to show you one of the tools we use. If somebody, if you want to call us, and we'll just mock up some things in the future for you based upon a Social Security estimate, the size of your IRA, how much you can take out. That's the kind of work that we do, and we'll be glad to do it for you. Now, as far as checking the boxes, we have talked quite a bit today about Social Security. I had an accident a little while ago, so that's what the cane is all about. I blew out my knee, and accident sounds a lot better than fall if you're a 65-year-old guy. But I fell, and really a serious injury to my knee. Um, we didn't really talk about long-term care. We talked about 401k and withdrawals. We haven't talked too much about estate. We've talked a lot about income, and obviously talked a lot about taxes. So I'd like to bring Tom back on. I'm Hans Scheil,
And I'm Tom Griffith.
and we thank you very much for listening.
Thank you.